The best trading strategy varies depending on individual preferences, risk tolerance, and market conditions. However, here's a widely used and effective strategy. 1. Trend following. Identify strong, persistent trends in the market using technical analysis tools like moving averages, trend lines, or MACD. 2. Entry and exit points. Enter a trade when the price confirms the direction of the trend, such as a breakout above a resistance level for an uptrend or a breakdown below a support level for a downtrend. Use indicators like RSI or stochastic oscillator to confirm overbought or oversold conditions. 3. Risk management. Set stop-loss orders to limit potential losses and preserve capital. Determine your position size based on the percentage of your trading capital you're willing to risk on each trade. 4. Profit targets. Set realistic profit targets based on the length and strength of the trend. You can use Fibonacci extensions, pivot points, or previous swing highs/lows as potential targets. 5. Trade management. Monitor your trades closely and consider trailing stop-loss orders to lock in profits as the trend progresses. Avoid moving your stop-loss too close to the current price, allowing for natural price fluctuations. 6. Stay informed. Keep abreast of market news, economic releases, and geopolitical events that could influence your chosen assets' prices. 7. Backtesting and analysis. Regularly review your trading performance, analyze your winning and losing trades, and adjust your strategy accordingly. Backtesting your strategy on historical data can help validate its effectiveness. Remember that no strategy guarantees success, and losses are an inherent part of trading. It's crucial to remain disciplined, manage risk effectively, and continuously adapt to changing market conditions. Additionally, consider seeking guidance from experienced traders or professionals if you're new to trading.